So back in 2020 during the pandemic, I decided to take one of my debt weapon tools, which was a home equity line of credit at the time, and make an unusual investment as a 50% owner in a sewer-related drain company. You can see that here, Small Town Drain. I'm all dressed up for tonight's community social where I'll be walking the streets and shaking hands and making introductions and obviously getting the word out about our company. Now that might seem like a strange business, especially if you have absolutely no background in drains or in running any type of trade business in the past. And of course, I considered that factor before. In fact, I still to this day probably couldn't even locate most drains or cleanouts. However, it just made sense. In the peak of when essential businesses mattered most, I was able to identify that that business was going to be extremely important regardless of what happened moving forward economically. I recognized through market analysis that it was a low competitive environment and that there was a desperate need in the area for a business like this. I saw that the profit margins were very, very strong. And I knew that because the competition was so busy already, that if we could step in and provide a service that was offered very quickly, we were extremely responsive in an area that's not typically customer service oriented, we could probably clean up. And here we are almost 3 years later, and that's exactly what we're doing. With a loan from a bank that was none of my own money, I was able to secure a 50% ownership position in the business in order to generate a consistent revenue. In fact, my current rate is $85,000 per year for that business, and it's mostly passive. The team that I have, including my business partner and the staff that we delegate to, they handle the 90% of the business, whereas I step in and handle what would be considered a very important piece, the business development, the marketing know-how, and just simply making sure that things are being run in a way that over exceeds expectations of our customers. I still only dedicate about 10% of the effort, I would say, to that business. And in fact, my daily contributions are well under an hour a day for that $85,000 per year. So ultimately, it turned out to be an incredible return on that investment. And in fact, we're looking at scaling that business quite dramatically to where we'd like to have 50 locations, each doing upwards of $3 million per year. Now, in a world where financial challenges are what many would think are the new norm, ensuring that your financial security is not a luxury is now essential. In today's video, what I want to do is explore your credit scores because they hold the key to navigating today's complex financial terrain. From securing loans to accessing credit cards, what I want to do is break down the vital role your credit scores play in every financial move that you make. You're not going to want to miss this one. Make sure you guys stick around for the whole video. So welcome back to the VIP Financial Education YouTube channel. I help you go further, faster financially. My name is Matthew Pillmore, and I'm the president of VIP Financial Education, along with several other companies, including Small Town Drain. And I want to explore why your credit scores matter more than ever, especially in the current financial landscape. Remember, credit is why I'm an owner of this business. And recent data reveals that it's become increasingly challenging for ordinary individuals to secure loans or gain approval for necessary tools as banks and financial institutions have swiftly started tightening their lending criteria. And this tightening of lending standards encompasses measures like outright rejection of applications, elevating minimum credit score prerequisites, imposing higher interest rates to those tools and loans, and of course, reducing credit limits altogether. And the credit crunch gained attention earlier this year, particularly after the collapse of several major banks, you might remember. And it describes a situation where consumers and businesses face difficulties in obtaining the necessary loans, potentially leading to an economic downturn. Although the broader economy has seemingly stabilized since then, the focus on how the credit crunch affects everyday people like you and me has diminished. And the credit crunch has received less attention in the news recently because there's fewer bank failures. However, despite containing full-fledged bank failures, the underlying banking system still faces many challenges, and it's become quietly tougher for consumers to access loans since that time. In essence, as lenders become more selective, the importance of having great credit scores intensifies, especially in the current lending environment where lenders are exercising greater caution. This data reinforces reinforces this perspective. The Federal Reserve conducts quarterly surveys of senior loan officers, inquiring about their willingness to extend loans to consumers. During the peak of the credit crunch concerns, experts pointed to the first quarter results as evidence of tightening standards. Subsequently, more lenders have become discerning, as indicated in the Fed's report, which mentions that a significant proportion of banks tightened standards for credit card loans and other consumer loans over the second quarter. Data from the New York Federal Reserve provides a different angle on this trend. By the end of June, the rejection rate for various types of loans, including credit cards, mortgages, auto loans, they had risen to nearly 22%, the highest in 5 years, and one of the highest since the survey's inception back in 2013. When lenders heighten their standards, it also can make the application process a lot more demanding. Banks might request additional financial verification, particularly related to income, which can pose challenges for gig workers or small business owners, especially. If you're a small business owner, you can relate. And we derive our income from self-employment. In a situation where the banking industry has less money to distribute due to inflation-driven interest rates and mismanagement, lenders tend to focus on the highest quality borrowers that they can find. They cherry pick them, which typically translates to individuals with great credit histories. Credit scoring firm FICO, which I hope you heard of at this point, defines a FICO score between 670 and 739 as good, between 740 and 799 as very good, and anything above 800 as exceptional. And currently, lenders are less inclined to engage with anybody whose scores fall below 670. However, even meeting the minimum requirements do not guarantee favorable terms. The interest rate offered can still vary significantly based on your credit score. For instance, data from before the credit crunch showed that someone with a credit score in the 600s might face an interest rate of 10.33% on a used auto loan, whereas an individual with a credit score above 720 could secure a substantially lower rate of just 3.68%. This seemingly modest difference in interest rates can actually translate into thousands of dollars in savings over the life of that loan, affecting monthly payments and the overall cost, along with, of course, your cash flow. Therefore, we cannot stress enough the current importance of maintaining a strong credit score through responsible financial habits like punctual payments, reduced high interest debt, and verifying the accuracy of your credit report, along with accelerated debt elimination. In times when lending options have become more limited, maintaining a high credit score offers more financial flexibility and opportunities for you, like the one that I've demonstrated at the top of this episode, for better loan terms. So remember, the financially fittest are the ones that take the necessary steps right now, every day, even if they're very small and simple steps. Now, I'm curious, have y'all experienced any changes in your ability to access credit in recent months? I'd be interested to hear how everybody's faring out there given the current conditions. Have you used your credit in the past to take advantage of opportunities like I described, perhaps not a sewer business, but maybe making other investments by tapping into your strong borrowing strength? Or maybe you're just simply there trying to make sure that you can get the best and lowest interest rates possible in order to maximize your bottom line net cash flow position at the end of each month. Let me know in the comments section below. Until I see you on the next video, folks, make it a great day today and keep on cash flowing. Take care.